Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. And this is going to be also a Gables Tax Planning Group podcast. Obviously, we're getting to the end of the year, so I want to share with you some year-end tax tips that all of you can take with you and can start implementing right away in order to maximize your income for the end of the year and also to minimize your tax liability as you approach the end of the year. First thing I want to share with you is when it comes to tax planning, sometimes you're the windshield, most of the time you're the bug. So therefore, our job in providing information to all of you, and then some of you that may decide to, work with us in the future, is to try to help you become as much of the windshield as opposed to the bug. We all know what happens when a bug hits a windshield at 60, 70 miles per hour. Now, the first thing that we need to understand as we prepare for your taxes coming up fairly soon is that there's a major difference between tax planning and tax preparation. Now, tax planning involves, the marginal and the management of your marginal tax brackets and tax forward assessment. Now, most of the, tax preparers that you see out there in the marketplace do not have the ability or the software to use tax forward planning, and you're going to hear me talk about tax forward planning for the next several minutes in this podcast. But I think it's very critical for all of you to make sure that you understand the difference between tax planning and tax preparation. Now, normally tax preparation involves a gathering of data and then determining the tax liability. And most of that preparation takes place between January 1st and April 15th. You can't do any tax planning between those dates. Tax planning is an evolution, is something that you need to do every single day for the entire year and for the rest of your life if you wish to minimize your tax liability not only now but also in the future. Now, tax planning involves a reduction of your effective tax rate. Now, in a best case scenario, in a perfect world, you want to reduce that effective tax rate to zero or at least to a single digit. Remember, there's a difference between the marginal tax bracket and your effective tax rate. Marginal tax bracket is the last dollar that you earn. Where does that fall in the tax table? The effective tax rate is the combination of all the dollars that you earn for the year and what the averages are, and then that would become your effective tax rate. So we always want to make certain that the majority of the clients that we engage in, that they end up either in the 0% tax bracket, not only now but also in retirement, but at worst case scenario to get them to a single digit tax bracket. Now, obviously 2018 is going to be a very critical year for most of you. Because of the fact that under the new tax law, there are obviously new deductions, new exemptions, and credits that need to be looked at. Now, just bottom line is that there are higher deductions and lower tax brackets, so the vast majority of Americans, contrary to what the pundits are saying out there in the news media, will be in a lower tax bracket in 2018 than in 2017 and beyond that. Now, one of the major challenges that all of you need to be aware of is that the TCJA, which is the Tax Cuts and Jobs Act, will sunset December 31st, 2025. Now, what do I mean by sunset? Well, it means that at the end of 2025, on December 31st, January 1 of 2026, unless Congress decides to extend the tax benefits and the tax cuts, everything will go back to the old tax law that ended December 31st of 2017. For those of you that are trying to do tax planning, you pretty much have an 8-year window in which to truly maximize your tax benefits, not only for now, but also for the future. Now, some of the tax planning rules of engagement that I want to share with you is that it requires a year-long planning, income forecasts, expense management, and when to deduct those expenses if they are deductible, and also financial statements and be able to do an assessment on those financial statements. That would include, your cash flow, your income statements, your balance sheet, if you happen to be a business owner, and we'll talk a little bit more about that. And most important, it also involves doing a 5-year tax forward planning forecast. You cannot do a really good job in tax planning unless you have the ability to do tax forward planning and do so over a 5-year period. And again, most of the tax preparers do a very good job in trying to help you minimize the tax liability for the current year, but they're always looking in the rearview mirror, because when you go to see, let's say in 2018 tax year, you will see your tax preparer somewhere between January 1 and April 15th, and then pretty much what your accountant can do at that point in time is, how much money did you generate, what were your expenses, what were your deductible expenses, any credits or exemptions that you may be able to obtain, and then obviously he or she will give you what your tax liability will be for that year. So that's pretty much a reactionary tax assessment, as opposed to being proactive in your tax planning and your tax assessment for the year. Now, you also want to review your 2018 versus 2019 filing tax brackets. Now, it's hard to do 2019, 2020, 21, 22, and 23 unless you have any type of tax planning software. You may want to consider shifting certain deductions in income to 2019. One of the things that you can do, depending on what your tax liability may be in 2018, most of the time, if you've earned a lot of money in 2018, there are some things that you may want to do in order to reduce that tax liability for 2018. Receivables, you can postpone your receivables until 2019 to at least the first quarter, so you don't take them in 2018, so that way you can take them in 2019 for the tax year. But then again, if you really don't know what your 2019 tax year is going to look like, then how can you make that decision of shifting or moving those receivables to 2019 as opposed to 2018? Obviously, deductions and credits have face-out thresholds that you need to be aware of. Consider using tax forward planning calculations from a qualified tax preparer. So whenever you're visiting with your accountant, your CPA, or your tax preparer, make sure that you ask them if they have the ability to do tax forward planning for you. If they don't, then obviously that could be a red flag, but make sure that you have that conversation with your tax preparer along those lines. Another big issue for 2018 is going to be your medical expense deductions. Now, in 2018, the rule is 7.5% of adjustable gross income. So any medical expenses that you incurred in 2018 that exceed 7.5% of your adjustable gross income can be deductible. Now in 2019 it will be 10%. So that means in 2019 any medical expenses that exceed 10% will be deductible from a business perspective. So if you have to make a choice between 2018 and 2019, I would rather you take the deduction in 2018 because you will be able to deduct more of your medical expenses due to the fact that the AGI, or the adjustable gross income, is down to 7.5%. Now, obviously, try to maximize your flexible spending accounts, which is something very critical for all of us, especially if you work for an employer that does provide that for you. Now, property taxes, or what is known as SALT, state and local taxes, that's going to be pretty big, not necessarily for us here in Florida, but for other states like New York, Massachusetts, New Jersey, California. Because of the increase in property taxes and the value of homes in those states, the TCJA capped the property taxes deductions to a maximum of $10,000, and they cannot be prepaid. So you have to do your math and make sure that you can, maximize that deduction, because anything above that is going to be wasted from a deductibility standpoint. Now, I think there may be some lawsuits now being filed in regard to that, but by the same token, you want to make certain that you do your due diligence prior to filing your income taxes. The same thing applies to AMT, which is the alternative minimum tax. The 2018, if you happen to be married filing jointly, it does increase the exemption to $191,500, and for everyone else, it will be $95,750. AMT usually apply for those of us that earn quite a bit of money, but we also have a lot of deductions and expenses that we can claim. So basically what the IRS uses AMT for is what is known as a catch-all. If you're able to deduct a lot of expenses and reduce your tax liability significantly, then the AMT is applied to your tax year and may increase your tax liability. And obviously it hits more and more Americans as we continue to make more and more money moving into 2019 and so forth. Long-term capital gains. For many years we've had obviously long-term capital gains. The TCJA, the Tax Cuts and Jobs Act, created long-term care capital gains tax brackets to run separate from the ordinary income tax brackets, and they're 0%, 15%, or 20%. Whenever I ask a client where they're at in their capital gains tax bracket, everyone seems to think that is 20%. And very, very few Americans actually qualify for 20% capital gains, and those are the, your upper middle class and your upscale Americans that earn a lot of money and then they have a lot of money in capital gains. For most of us, it's going to be somewhere between 0 and 15%. Now, if you're considering long-term capital gains for the 2018 tax year, you may want to consider what is known as loss harvesting. Harvesting, meaning that if you have a loss in a portfolio, let's say that you own a stock in 2018, the rest of the portfolio is doing very well, but this particular stock has actually lost money in 2018, and if you want to reduce your tax liability, it may be a good idea for you to sell that stock at a loss in 2018, so you can offset that loss against capital gains for the 2018 tax year. Now, if you don't have any capital gains because you're not selling any of your profitable investments, then the IRS and the rules allow you to deduct up to $3,000 in capital losses against ordinary income. So you can do that, but then again, the max is $3,000. Where you need to be careful with loss harvesting is to try to avoid the wash sale rule, which basically says that if you sell a stock at a loss, let's say in June of 2018, and then within 30 days you buy the stock back, thinking that now you're going to be able to stock back in 2018 and be able to buy it back because you foresee the stock to do better in the near future. But then again, you want to maximize your losses on that stock for 2018 because of the fact that you purchased that stock back within 30 days of the sale, of the original sale, then the IRS is going to think of that and is going to give you what is known as the wash sale rule, which basically is going to negate that loss that you wanted to claim for that tax year 2018 on that particular stock. So you have to be very careful if you're interested in selling a stock at a loss and then buy it back. Make sure you buy it post that 30-day period, because otherwise it's going to come back and create major issues for you from a taxable standpoint. Now, you also may, if you want to reduce your long-term capital gains, you also may want to avoid the sale of profitable investments, depending on tax forward planning calculations that you and your tax preparer should do. You can either avoid selling the entire stock. So if you own 1,000 shares of a stock that is doing fairly well and you want to sell that stock, depending on what your tax liability is going to be in 2018 versus 2019, it may be more suitable for you to either delay that sale until 2019 or perhaps do a partial sale in 2018 and then do the rest of the sale in 2019. Now, one of the things I always caution my clients whenever we do any type of tax planning is that it is very critical for them to understand the differences between the three taxable buckets that we have under the IRS code. You have the taxable bucket, the tax-deferred bucket, and then the tax-free bucket. Now, the taxable bucket, as we've talked in the past, it includes your savings, your CDs, your traditional mutual funds, and so forth. The money in that bucket is after tax, but it is taxable every year. So from a taxable perspective, it's not a very good bucket to own, but it is a bucket that does give you a lot of flexibility and liquidity. So because of their tax liability, we do place certain limitations as to how much money you should keep in that bucket. Same thing with a tax-deferred bucket. This is a bucket that contains, your qualified plans. Your IRAs, your 401ks, your 403bs, your pensions, and so forth. Traditionally, now there are some exceptions to the tax-deferred bucket when it comes to real estate and non-qualified annuities and so forth, but traditionally the money that you put in is pre-tax. The money grows tax-deferred, and then when you pull the money out, you have to pay taxes on the whole thing because of the tax liability that many of our clients are, and many of you are going to be facing in the future because of where we feel taxes are going to be in the next 10, 15, 20, and 30 years. You have to also cap the amount of money that you're going to keep in your tax-deferred bucket if you want to minimize your tax liability in retirement. And then last but not least is your tax-free bucket, and those includes your Roth IRAs, your Roth 401ks, your municipal bond funds, and your 7702 plans, which are cash value life insurance policies that are segmented primarily to maximize the effectiveness of the tax-free bucket. Now here the money that goes in is after tax, the money grows tax-deferred, and then you're able to pull the money out tax-free. So obviously this is a bucket that all of you should be able to maximize between now and your retirement, but sadly enough the vast majority of Americans do not know enough about this tax bracket and how to enhance its opportunity. Now, obviously, the tax-deferred bucket, there are certain guidelines. The IRS controls how much money you can put in, how much money you can take out. In 2018, if you're putting money into a 401k, the most that you can put in is $18,500. But if you're at least if you're age 50 or older, the IRS gives you a $6,000 contribution catch-up in order for you to max out your contributions to the 401k. Sometimes that's a good thing. Sometimes that's a bad thing because it can create all kinds of other issues along those lines. Also in 2018, if you're making contributions to an IRA, the maximum that you can put is $5,500 in 2018. But if you're age 50 or older, then you do have a catch-up contribution of an additional $1,000 that you can make. For 2019, your contribution limits have actually gone up. So for your 401k, instead of $18,500, will be $19,000, and then the catch-up contribution will remain at $6,000, and then for 2019, your IRA contribution will go from $5,500 to $6,000, and then you'll also have the $1,000 catch-up contribution if you happen to be age 50 or older. Now, obviously, the tax-free bucket is the one that we assist the vast majority of our clients in maximizing because you want to make the most amount of your contributions to your Roth IRAs and Roth 401ks. and then your maximum disposable income should go to your 7702 plan, so your cash value life insurance plans, because not only do they provide you with a tax-free retirement distribution at retirement, but also 7702 plans help you reduce your exposure to the fatal four, which is the risk of dying too soon, the risk of living too long, the risk of living with a disability, and last but not least, the risk of living with eroding factor. So if you really want to reduce your tax liability in the future, you need to fill that tax-free bucket to the very top when it comes to contributions. Now, you notice that although municipal bond funds happen to be in the tax-free bucket, I didn't mention it in order to maximize. And the reason for that although municipal bond funds or the income that you receive are free from federal income taxes if you did them the right way, they do add on to the provisional income calculation in order to determine what percentage of your Social Security benefits are going to be taxable in retirement. So municipal bond funds do not qualify for my definition of totally tax exempt. Now, also, for those of you that are into retirement distribution, be very careful. If you're turning 70 and a half in 2018, required minimum distributions, or RMDs, are required no later than April 1st of 2019 for the 2018 tax year. So that means that if you turn 70 and a half in 2018, you can either take your RMDs this year, or you can postpone them until April 1st of 2019 and then be able to do so. The question is, well, does it make sense for us to postpone that tax liability or that 2018 RMD to 2019? It depends on your tax forward calculations, and that's where tax forward planning comes into play from a business perspective. And the reason for that is that if you decide to postpone your required minimum distributions in 2018 for 2019, then the challenge is you're going to have to take your 2018 RMD no later than April 1 of 2019. But then by December 31st of 2019, you will have to take a second distribution in the same tax year in order to meet the 2019 retirement. So you really have to understand and know what your tax liability is going to be in 2019 versus 2018 in order for you to determine whether it makes sense for you to wait or not. And now also be aware that RMDs apply to all traditional qualified plans, IRAs, and also if you happen to own a Roth 401k and you turn 70 and a half in 2018 and you do separate from service, then RMDs are required on a Roth 401k. Now, if you roll the money out prior to turning 70 and a half to a Roth IRA, then obviously Roth IRAs do not require an RMD at any point in time. So if you want to take control of your taxes in retirement, then the quicker you start converting your Roth 401k to Roth IRAs, the better off you're going to be. And then obviously the sooner that you can start converting your traditional 401ks or traditional IRAs to Roth, the better off you're going to be. Now, obviously, be careful as you do any type of Roth conversions, because you have to be able to pay the tax today. But then again, we're living at the third lowest possible tax bracket in the history of our country. And when you take a look at the national debt, which is exceeding $21 trillion at this point in time, the unfunded liabilities for Social Security, Medicare, Medicaid, and Medicare Part D, which exceeds $114 trillion today, which is basically liabilities that the U.S. government and the promises that the U.S. government has made to all Americans, in which they don't have the money to fund it today. There's a very, very high probability that taxes are going to be a lot greater in the future than they are today. On top of that, most of your deductions and exemptions when you retire are going to be gone. So even if taxes were to stay at the same level that they are today, which more than likely they will not be, your tax liability may actually increase because you start losing your deductions, exemptions, and certain credits that you were receiving while you were employed. So obviously you have to be very concerned about that as well. Now, the next section is your provisional income calculation. If you're thinking about taking Social Security benefits, you have to do a provisional income calculation, and this is something that we do for our clients often, because when you do provisional income calculation, you get to determine what percentage of your Social Security benefits will be taxed. See, if 100% of all the income that you had in retirement came from Social Security benefits, or came from your tax-free bucket, excluding your municipal bond funds, then obviously you would not pay any taxes on your Social Security benefits, and you would live life very, very well from a business perspective. So what causes the taxation of your Social Security benefits is not the Social Security benefit income that you receive, but it is all the additional income that you may have coming to you during that tax year. So ordinary income, capital gains, income from municipal bond funds, and half of your Social Security benefits will be taken into the provisional income calculation in order to determine the taxation of your Social Security benefits based on the thresholds, whether you're married filing jointly, single, or head of household, or whatever that may be. So your ordinary income includes if you have a part-time job or if you retired, but you continue and now you're receiving Social Security benefits. Any withdrawals that you make from your IRAs, your 401ks, your 403bs, any pension benefit that you may be receiving gets added on to the provisional income calculation in order to determine what percentage of your Social Security benefits could be taxed. Now, in a perfect world, 0% of your Social Security benefits should be taxed. In a not-so-perfect world, up to 50% of your Social Security benefits may be taxed, or in a really bad tax world, up to 85% of your Social Security benefits, yes, you heard me right, up to 85% of your Social Security benefits may actually be taxed in retirement. Now, one of the things that we share with all of you weekly is that having a customized tax-preferred retirement blueprint is very, very critical for many Americans. And this is one of the specialties that we have here in our firm at Gable's Tax Planning Group, which gives you the ability to reduce and or eliminate taxes in retirement if you do it properly. And there's a sequencing in which to do your customized tax-preferred retirement blueprint. It also gives you the ideal and the ultimate balance between your taxable bucket, your tax-deferred bucket, and your tax-free bucket. And it also reduces and or eliminates any assessment or risk that you may have to the fatal four that we talked about a little while ago. The risk of dying too soon, living too long, living with a disability, or living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, and the like. Now, what if you happen to be a business owner? How can you maximize your tax liability for 2018 and beyond? Obviously, you should, if you own a business or if you happen to be self-employed, you may want to purchase and or lease equipment and supplies prior to year end. Why? Because then you can take a business tax deduction for that. If necessary, you may want to pay your payroll tax deposits, or you may want to make payroll tax deposits in 2018 instead of having to wait until January 15th of 2019 for the fourth quarter 2018 tax year. So if you make the deposits in 2018, you would have to take you then can take the deduction in 2018 instead of having it for 2019. You may want to avoid collecting your account receivables or invoices until the first quarter of 2019, and we talked a little bit about that a few minutes ago as well. So it may make sense for you to wait until 2019 to collect on those receivables, but by the same token, you need to be aware as to where you're going to be in 2019 by doing proper tax forward planning calculations. How about your passive losses? They're limited, or are they deductible in 2018? So you should visit with your tax preparer way before the end of the year so you can start making changes and making adjustments to your 2018 tax year. The same thing should apply to your net operating losses, for 2018. So your carry back, your carry forward, make sure that you know exactly where you're at from that perspective as well. Charitable deductions, whether they're cash or non-cash, try to maximize those deductions for 2018 if you want to reduce your 2018 tax bill. If you're self-employed or you happen to be a business owner, consider putting together an employee benefits program. And that should include or could include a GIBA, which is a golden executive benefits arrangement, or straight out bonuses you can give to either all of your employees, some of your employees. You can separate the bonuses depending on the ranking of your employees, if you have middle management, upper management. So you're able to do all kinds of things that allow you to keep your employees happy, give them an additional bonus at the end of the year, an additional benefit. But by the same token, make sure that you can place some golden handcuffs and some vesting schedules so your top employees and your top managers can stay with you for years to come. Now, the other thing to consider for 2018 is be aware that there's a difference, obviously, between your standard deduction and your itemized deduction. Now, in 2018, the standard deductions have actually gone up. So if you're married filing jointly, your standard deduction in 2018 is $24,000. If you're single, is $12,000, and if you're head of household, is $18,000. And then obviously there's also deduction for the aged or the blind. So if you happen to be at least 65 years of age or blind, you can receive an extra $1,300 deduction along those lines. Now, according to the IRS, because of the increases in standard deductions that apply to each and every tax filing American in 2018, only 25% of Americans will itemize in 2018 through 2025. So, many a times, if you had deductions that were above and beyond the standard deduction, then you would have no choice but to do the itemization, and you would itemize your deductions for that given year. But now, because of the fact that the standard deduction rates have increased significantly, almost double, there's a high probability that only 25% of Americans, maybe 30% at the very most, will actually have to itemize instead of just taking the standard deduction. So that's something that is very, very critical for all of you to understand as well. Now, when you do look at your standard deduction, if you happen to be in retirement and you're taking money out of your qualified plan, if you do it properly, there may be a way in which you can take money out of your qualified plans, 401ks and the IRAs without having to pay any tax liability if you did provisional income calculation, because then, your standard deductions, credits, and exemptions can offset those liabilities, and then you can have the best of all worlds. Again, when we do a customized tax-preferred retirement blueprint for our clients, what does that entail? I just gave you what the benefits were a few minutes ago, but what does it entail? Well, number one, we would provide those clients that engage us in a customized tax-preferred retirement blueprint with a Social Security report that will determine what would be the best time and the best way to actually start receiving your Social Security benefits. And that's an incredible report that we provide under this package scenario. Number 2, we do tax forward planning report, and this tax forward planning report will actually it will be a 5-year tax forward planning report that will be able to give you your tax liability over the next 5 years, and it would give us and give you the ability to be able to manage that tax liability over a 5-year period, and thus be able to minimize your tax bill as well. Number 3, we provide income distribution calculations report to really enhance the distribution rate out of your assets in the taxable bucket, the tax deferred bucket, and the tax-free bucket in order for you to maximize your internal rate of return on the distribution so you can keep more of your money while at the same token reducing your tax bill and tax liability as much as we possibly could. Number 4, we provide a financial tax buckets efficiency report that will determine how much money should you keep in each and every one of those buckets that are so critical if you're truly interested in minimizing your tax liability in the future. In number 5, last but not least, we will give you a Fatal 4 risk management assessment report, which will address the risk of dying too soon, the risk of living too long, the risk of living with a disability, the risk of living with eroding factors like taxes, inflation, market volatility, interest rate volatility, and so forth. And this package that I have just explained to you formulates our customized tax preferred retirement blueprint. Now, obviously, if you're really interested in learning more about this, please feel free to call me or email me, and you can schedule a 30-minute strategy session with me at no cost and no obligation. My telephone number is area code 786-766-1042. You can reach me at Bert, B-E-R-T, at GablesTaxGroup.com. You can also email me at Bert, B-E-R-T, at BertSalazar.com, or you can also go into our website, which is www.GablesTaxPlanningGroup.com, or actually short, it would be www.GablesTPG.com. T as in Tom, P as in Paul, G as in Golf.com. GablesTPG.com. Again, I want to leave you with a final thought, because at the end of the day, when it comes to providing seminars, webinars, podcasts, and education and financial literacy that we do for all our clients and all our listeners on an ongoing basis, my number one job with all of you is to kind of help you and your family change the way that you see things. Because when you change the way that you see things, the things that you see change. Again, thanks very much for giving me and giving us a few minutes of your time today, and we'll talk again next week. Take care. Bye.